First of all the participants, very good afternoon. My name is Suresh Kumar Reddy. I'm the host for the today, the quarterly update con call on ASK Special Opportunity Fund, ASK Specialized Portfolio. To update on the specialized portfolio, regularly how the Gagan was updating the last couple of quarter con calls. So this quarter also he would like to update. Before that, he would be giving into what's happening on the market and the way forward about our portfolios, how the earnings has been shaped up for the portfolio. Post that, we will have a Q&A session with Gagan. So I request all the participants, they can type their questions in the chat box so that all the questions will be taken to the Gagan to answer those things. With this, Gagan, hand out to you. You can continue your call.
Thanks, Suresh. Good evening, everybody. Welcome you on the webinar for Specialized. I'll put you through a brief presentation and I'll run past, some of the latest developments at the corporate and macroeconomic level, and we'll then go into a question and answer session. I presume all of you have seen the volatility in the markets, and the Indian markets have seen some steep correction in the last quarter. And from the peaks, the Indian market is down 15%. And CYTD Nifty, the index is down 6%. And India is perhaps amongst the markets, emerging markets, which has seen some of the most steep corrections. We further break it down temporally. We'll find that Q4 FY25 Nifty is down 6%. Mid cap index is down 16%, and the small cap index is down 22%, within which February has been the month with the steepest fall. The indices being down 6%, 11%, and 13% respectively for February. Right. And year to date, we've already seen calendar year 25 in the large cap index, Nifty 50 is down 6%, mid cap 16%, and small cap 22%. While the large cap index itself, the correction itself doesn't seem, extreme in the absolute value. If we further break it down script wise, almost half the scripts in the large cap index have dropped by more than 30%. So, the headline value of the drop in the index does not reveal, the level of drop across the stocks which constitute the index. For mid and small cap, you can see 2/3 and 80% of the stocks which comprise the index are down by 30% or more. So that's a fairly steep fall for a fairly large number of stocks which constitute the index. Obviously, one would like to understand what are the underlying reasons, and I think I've discussed it in the past, and most of you are also fairly cognizant of the fact that the valuations in the mid and small cap market section were fairly high compared to their past. And some of the developments at a macroeconomic or geopolitical level perhaps were the straw that broke the camel's back, so to speak. We've seen there is a steep currency devaluation, which obviously impacts the dollar returns for FIIs, the foreign portfolio investors who in any case, given that there's a 5% risk-free yield in US, and there's a change of government which is pro-business, and the government in its latest pronouncements have talked of imposing stiff tariffs, trade tariffs. These have all triggered portfolio reallocations for FIIs out of the emerging markets into US, and obviously India being one of the most pricey equity markets saw a fairly steep correction because of this. Adding or exacerbating the problem was the fact that you recently had, regulatory restrictions on mutual funds in terms of, the participation they can do on the prices at which they can participate in trade. So they have to participate at VWAP, and the participation cannot exceed a certain fraction of the stocks outstanding, and that perhaps has caused an impact on volumes and further impacted the price drop. The government, add to that, or at a macroeconomic level, the government up to last year was investing heavily in capital capex or capital expenditure, 5-year CAGR of more than 25%. But that has moderated in the recent past, especially post-elections. And now the focus is more on revenue expenditure. You already have noticed, the tax exemptions that the government has discussed in the latest budget. It has also moderated its total overall capex spend growth to 10% compared to the 25% figure. And while there is talk of controlling and bringing down the fiscal deficit further, in a situation where tax collections are going to come down, both because of the exemptions and also because of a moderation in GST collections and further moderation in capital gains and STT, it seems a stiff target to achieve unless the revenue expenditure or the capital expenditure of the government is further curtailed. So, I mean, that leaves still less room for prime pumping the economy and maintaining a high growth. And finally, the commentary coming from corporates has also been a mixed bag. But the growth trends have been moderating across the board. And these perhaps were reasons because of which, we've seen this fairly sharp correction. Just to put it into perspective, if you look at the bar chart here, you can see that the Nifty P valuations have, which were at a peak at around September 24, have corrected down from their peaks. But that correction has been, commensurately in line with the Nifty earnings estimate, forward earnings estimate correction. So the forward earnings estimate's gone down from 1377 rupees to 1354, and then now sort of bounced back somewhat. So there's a drop in earnings estimate across the board, and obviously, fundamentally speaking, valuations will move in line with that. So if you look at forward multiples, Nifty today is almost at its 5-year mean, and just about a slight premium of 5% to its 10-year mean. Whereas the mid-cap indices still, mid and small cap indices still have some more room to go before, at an overall basis, they fall in line with their long-term averages. And this gives you, some idea of how the earnings growth in Nifty, has moved. And you can see the earnings growth in the first quarter of this year in aggregate was 7%, second quarter was 8%, and now third quarter it's improved to around 16%. X of financials, the growth is 13%, and specifically for domestic focused companies, the growth is at a mere 4%. So there is moderation in earnings growth for the domestic focused part of the index. This will give you further more details into Nifty and its sectoral composition and the growth therein. So if you look at Nifty, overall revenue growth, it's been coming down. First quarter of the year was 10%. from fourth quarter of last year, the trend's a continuous downtrend. Aggregate sales growth for Nifty going down from 12% to 10, 7, and then 5. And likewise for the EBITDA growth, which is just about bumped up back in 3Q, but was on a fairly steep downtrend from 15% to 6, 4, and then 10 in 3Q. And I mean, the trends excluding financials, is a further more exaggerated slowdown is visible across the board. At a sectoral level, some of the standouts in terms of growth, momentum still being fairly decent is the NBFCs, the infra, telecom, industrials, and pharmaceuticals. But obviously, it's counterbalanced by weakness in cement, auto of late, energy, tech, metals. These are all segments of market which have seen a fairly moderate pace of growth. What's the future growth estimates at a Bloomberg consensus level? Nifty earnings growth for 26 is at 14% and 13% for 27. Perhaps you could see some more moderation, and very likely, the estimates would come down closer to 12%, 10 to 12%. Within that, obviously there's a sharp turnaround being estimated for cement, which has had a fairly weak year in terms of profits at 25, and costs are normalizing, and therefore, earnings growth estimates are fairly sharp in cement. Financials, by and large, maintain that moderate clip of growth, but are at very reasonable valuations. Within financials, obviously, the highest growth momentum is estimated in NBFCs. Telecom and healthcare services, again, are two standouts in terms of a consistently high growth being estimated both in 26 and 27. The other factor which impacted valuations clearly was flows, and it's largely coming from the foreign institutional investor taking money out, and we can see India as a destination since October 24 has seen perhaps the highest outflows compared to some of the other emerging market peers. In terms of domestic participation, the SIP flows now, the growth is moderated, but in absolute terms, the SIP level more or less is maintained. The indices we discussed, Nifty is now fairly close to its long-term average. But then you can further break it down, and look at indices other than Nifty, and also sectoral indices, and you'll see that there's been a steep correction, and now most indices seem to have converged to their 5-year means, apart from the Nifty mid 150. Mid and small is also now almost there in terms of converging to its long-term means. Pharma, which had, where valuations had run up in the recent past, is also now moderated, and the valuations, at least on a trailing basis, look, very much in line with long-term averages. IT converged to 5-year, but still at a premium to 10-year levels. FMCG is there at its long-term averages. Likewise for the private sector banks. The public sector enterprises are still at a premium to their 5-year means. Coming to the portfolio, just to give you a flavor of the construct of the portfolio, large caps constitute 40%. and the balance is equally divided between mid and small cap. Sectoral exposure, capital goods here includes, companies which may not necessarily be order book driven. So, our constituent holdings in capital goods include electronic contract manufacturing companies like Dixon and Sigma. They also include, some companies which are, supplying consumable nature products to the industrial segment, not necessarily large or heavy capital goods. And our second largest exposure is healthcare, which is at around 15-16%. And financials bring up 10%, and then, smaller constituents. In terms of portfolio actions, you can, for year to date, you can see the changes we've made to the portfolio. We've introduced or added to healthcare through Polymedicure and Emcure, and we've added Keynes and Dixon in the EMS and OSAT space. Gravita has been an addition in the circular economy or recycling. Varun Beverages, from a consumer staples perspective, we thought we needed to add to the portfolio. We built up positions there. And exits largely, based on either the prices having shot up beyond our fundamental valuations, or we felt that the investment thesis itself has either moderated or not worked out the way we thought. So these are the exits. Dalmia, where our fundamental thesis didn't play out. Bharat Electronics, it worked very well, but we booked profits. Patanjali, again, a case where the thesis didn't work out in terms of growth. BHEL, more to book profits. Likewise for Naveen HBL and some profit booking in Bharti, where we still hold our position through partly paid up shares. This slide gives you a sectoral drift of the portfolio over a period of time. And you can clearly see healthcare, we've indexed up in healthcare, come down in financials, and built out position in consumption as well, and in the infrastructure engineering space and utilities. For the portfolio, Q3 performances were pretty strong, as is visible. Sales growth of 25% and net profit growth of 33%. This stands out in stark contrast to the Nifty XOMC Nifty 50 sales growth of 7% and profit growth of 4%. In terms of our future portfolio future growth estimates, again, we maintain a healthy 25% plus growth estimate for our constituent holdings for 25 and 26, which is ahead of what is forecasted for Nifty. This is again a flavor of the portfolio psychographics. The ROE, ROC, which is essentially capital efficiency of the portfolio, and the earnings growth of the portfolio, as you can see, is fairly strong, albeit at valuations which are at premium to the Nifty. But in terms of price earnings to growth on FY26, the portfolio is almost there at 1. And this one gives you a flavor of the returns movement. Obviously, Jan and Feb were two fairly punitive months for us. We've recouped back somewhat in the first week of March, and the portfolio today perhaps is at a marginally higher level over the index. So I'm through with my presentation and we can jump into the Q&A.
Thank you, Gagan. Taking into the macro as well as the micro of the portfolio, where you are standing, how it is going to benefit, and you covered the earnings part also, the forward earning of these sectors, which will help the all the participants to where actually which segment we are there. Now, participants, I request you all the people to keep on typing the questions in the chat box. And there are some questions which is very common questions I will be asking to the Gagan. In the meanwhile, I request all the participants to type the questions in chat box. Gagan, before the before participants is coming to the picture, there are some common questions which has come for this portfolio, and some of the macro related questions also. So we need your help on the to understand that. One, you've been explained a bit, little bit covered on the trade war, what's happening on the currently. So can you be a little bit elaborate on that? How it is impacting on the Indian economy? Is it how much we have insulated? Is further, is there any trade wars which is be going to continue? Uh, uh, At the same time, the portfolio switch towards the more on capital goods and healthcare and the financials. Will it have a more impact on that, and how we've been going to insulate? So that which will give you more clarity on.
Okay. So, specifically, if you look at the tariff structure on a blended average basis, the tariffs on the US goods getting imported into India stands at around 10.3% odd, and the tariffs that US imposes on goods being imported from India into US is on an average of 3%. So there's a 7% differential, and the US government basically, indicates that they will follow a reciprocal policy. So either on a blended basis, we have to reduce tariffs, or they have to increase tariffs and bring it to parity. Specifically, the focus, pointed out by the US government is on the pharmaceutical industry, where pharmaceuticals, semiconductors, and automobiles, where they have indicated that they want to start with a 25% tariff and then increase it rapidly over a period of 1 year. So how does that impact the trade situation and the pharmaceutical companies? To put it into perspective, there was a recent interview, and I quote, this is Lupin's CFO, who a couple of days ago indicated that the average cost structure of manufacturing in India for pharmaceuticals, the average cost is 1/8 that of US. So cost of manufacturing the same products in US would be 8 times that of India. That is a fairly steep, cost arbitrage, and I don't think that can be knocked off with the kind of tariffs being talked about. That is one. Secondly, while by value, the generic drugs market in US could be only 10% of the total. By volume, it is much larger. It probably is closer to 70% by volume. So if you are going to put the kind of tariffs that you're talking of on pharmaceutical businesses, you're going to increase the cost of medicines for the American consumers. This is presuming that the tariffs would be passed on. I'm sure most companies will make an attempt to pass this on. If you look at what the Indian companies have gone through in the last 4-5 years in US, the US, the distribution there is very concentrated in the hands of 3 or 4 companies, which control almost 85% of the distribution in US markets. And they keep on taking or squeezing more and more discounts out of the manufacturers, but they don't pass it on to consumers. And this has already been discussed in the US Congress. that those benefits have not been passed on. More importantly, in a bid to do that, they have squeezed the profitability or the capital efficiency of the Indian companies, or for that matter, other generic manufacturers, to a degree where it didn't make sense. It was not viable to invest more dollars in this business. And you obviously therefore saw a lot of large companies forfeiting their ANDAs, stopping further allocation to the US business. This all happened a year or so ago. And the last year has been a year of respite for them, where price erosion is moderated, number of suppliers for on average supplying per drug have come down, and the business economics of doing generic business in US has improved. Improved somewhat. I'm not saying that it's improved, drastically. Given this situation, obviously there will be reluctance to further invest in the US generic business. Again, while the American government's target is to try and nudge manufacturers to come to US and set up facilities, it won't make any capital allocation sense to do that in the first place. Even if one tries to do that, it'll take at least 2 to 3 years to set up the plant, another 2 years to get your regulatory approval. So it's a very long run project. Finally, is this targeted specifically on Indian manufacturers? No. So the policy is specific to products or to sectors, in which case, the pecking order of cost competence does not change. So the Indian manufacturers vis-a-vis the Chinese, Bangladeshi, or European manufacturers, still retain the kind of cost advantage that they have had so far. It's just that for everyone, the costs escalate sharply. If there are, further additional announcements specifically to Indian manufacturers in terms of tariffs, they've sort of, discussed this or talked about it, but final actions are not yet there on this. But in case some such thing happens and there's a differential pricing, then there is an issue of cost competence, and perhaps then market share losses might happen. But even if one were to look or peep down that alley, the kind of products which are going off patent down, you're going to have a second patent cliff. Large amount of very high value drugs are going to come off patent in the coming 3-4 years, but most of them are going to be either biologic drugs, or they're going to be complex delivery format, extended releases, transdermals, injectables, within injectables, microspheres, or liposomal. So not something that can be easily done immediately. These drugs, the R&D itself takes 2 to 3 years or more. I mean, companies like Lupin and Reddy's have now been working on doing injectable filings for 5 to 7 years. It takes a lot of time to build expertise and file. So I don't see that situation changing. And invariably, I think, to that extent, the balance of power rests with the Indian companies, and the situation should not impact them, even in the worst case, by too much. Then coming on to the auto piece, direct exports of auto from India to US are not very significant. But indirectly, it's, through tier 1 or tier 2 vendors based out of Mexico or Europe, to whom Indian vendors supply, and then those components are finally going to US as parts of vehicles there. There is a certain value at risk. Obviously, the question then is, how does this work out? If the Indian companies try to pass on completely, obviously the demand falls because pricing moves up in US. Secondly, you could have a situation where everybody doesn't want to pass on. Some people, simply to ensure that their capacities are utilized, may be willing to absorb costs. So there will be some impact there. Companies like Ramakrishna Forgings or Bharat Forge have talked that, of certain value at risk in terms of exposure to US. For example, in Ramakrishna Forging, direct plus indirect exports to US is 400 crores out of a total turnover of 4,300 crores. So 8 to 9% value at risk. But will this completely vanish? It won't completely vanish. Possibly, some amount might be lost in terms of profits. And finally, in terms of semiconductors, again, we are not a semiconductor base by any standards. But what can happen is, let's say you have mobile exports, into US from India, where you have electronic contract manufacturers who do the final assembly of mobile phones. While a large part of their business is India, some part of it, is exports. Uh, 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 how does that impact them? In exports, I am still unable to clearly understand, because they buy the components and finally assemble it. So the component manufacturer is going to pass it on to them. Obviously, their raison d'etre to exist is simply that they are cost competent. So they'll definitely not be in a position where they'll be able to pass it on fully. But I cannot enumerate because I do not fully understand how this impacts them. So that's my understanding of the tariff issue. I think this is more a bargaining chip, being used by the US government to bring the terms of trade in their favor. I don't think this is going to be something that's going to continue. Obviously, they'll look for a quid pro quo somewhere else from the Indian government and balance it out.
Thanks, Gagan. I think that will give the picture of the pharma, auto, semiconductor, might be the pharma, which since we have a mode in upper hand on that will not be less impact. Another are very less businesses will be less impact on the long term point of view. That give you the more clarity on the sector point of view. Now, if you look at in the earnings of the portfolios has come on extremely good on the our perspective. Okay? In that's about your given number of 30% everything. So the most of the investors' question is how long it will take to translate into the returns. See, if you look at in the January, February, I think very tough to put it on that. But I think we had a sharp fall on the January, February. October, November, December also had a more volatility. But these earnings are coming very good. To translate in the earnings, you require flows absolutely on the from domestic as well as the FIIs. So, like in next 2 years or 3 years point, so will you able to see that flows from the FIs will coming back? If they're coming back, what actually is driving them to come back?
So, it's difficult to assess whether flows can come back or when they can come back. Finally, flows are essentially chasing yield, right? The way it was a couple of months ago was you had a 5% risk-free yield in US. The earnings yield in India was less than that. Earnings yield is simply a reverse of the P. And what was the point of taking that kind of risk, further taking currency risk, when you had that kind of return available in the US, especially with a pro business government coming in, which is trying to ensure that businesses have a better time in US. So has that equation changed? I mean, it's changed, yes, but has it changed to become so compelling that the FI money can come back in India on a very short notice? I doubt, because from a fundamental perspective also, we're perhaps not at a stage where the economic growth is going to be superlative by any stretch of imagination. Last 5 years, the growth was driven largely by government investments, and therefore, the kind of sectors that have moved is evident, right? Private consumption has not moved and still not moving, right? It's only moving in small pockets. On an aggregate basis, household incomes haven't really grown. Inflation on an inflation-adjusted basis, household leverage is at a peak. Job creation is not necessarily very good, and wherever it is there, it is of a lower order kind of gig work kind of growth or growth in agriculture. So that doesn't really portend too well for consumption growth. The government has therefore taken this step of tax exemptions, but the tax paying pool of people in India is 8 to 9 crores, within which tax filing pool. Actually, out of that, there's only a 3 crore pool of people who are actually tax paying. The rest are just filing returns to ensure that they don't pay taxes. 3 crore people, if at a family level, that means basically 4 people per family, that represents 12 crore people, with extra money to spend out of a total population of 140 crores. So that's again a thin strata of your population base, which can therefore consume. Will they immediately start consuming? I doubt. They'll first ensure that their balance sheets are repaired, their leverage comes down, and then consumption can come in. And therefore, obviously, leverage consumption is not going to go up. What can happen is unleveraged small ticket consumption can go up, which you see somewhat in the recovery of QSR sales. You see somewhat in the recovery in tier 2, tier 3 focused apparel and general trade retail, companies like V-Mart, V2, Vishal, Megamart. They've seen a healthy kind of growth in their businesses. Agriculture, agricultural incomes might from here on grow better. Soil conditions are pretty decent. Rabi crop was good. But again, not the kind of income in hands that could lead to a very sharp or sustained growth in consumption. So again, exports again is impacted, because of the trade tariff situation. Consumption is impacted because of household balance sheets being where they are. That leaves you only with government and corporate capex, right? Private sector capex. Private sector capex is a function of their own experience of how demand is moving and how capacity utilizations are. Utilizations on an aggregate, as per RBI standard, 75% to 80% range. Consumption growth is fairly moderate, so they are in no rush to invest. And government has its own constraints because it's letting go of certain tax revenues. It's facing two contrasting complex issues. One is to support the currency, but if it tries to support the currency, it cannot cut down interest rates because the yield differential will further narrow down. So how do you balance these two? And how do you balance an increase in RevX and CapEx with your tax inflows coming down? So not a situation where growth can come back very, very quickly or very sharply. It will take time to mend, and therefore, FII flows will not come in very soon, as far as I can see.
Now, when it comes to the portfolio, about almost 57% is into a small and mid cap. On one side, your chart says that the large caps are at the premium of minus 12%, minus 15% to the average thing. But in the mid and small cap, which still are to the valuation has been little bit stretched. Than the relatively 2 months back now, yes, the ease of happened. But since the portfolio towards about nearly 60% of the portfolio in small and mid cap, will it take a time of the market consolidation will happen, then it will U-shape recovery if it happens, because the small and mid caps are there. If how you are going to act on the portfolio at the moment? Is it are these small and mid caps have a very strong earning that will not have a problem of the suppression of the de-rating will happen on the portfolio? How you are facing what is going to act on these small and mid caps valuations?
Okay, so when we constructed the portfolio, the underlying thesis was as follows, that at a time where growth is at a premium, it is best to position ourselves in areas where growth is secular and clearly evident, right? We therefore didn't want to be, overly exposed to areas where growth is the derived function of household income or government spends, right? But government spends in secular areas. So while government spend overall might come down, it will be there very strongly in areas like renewables. It will be there very strongly in areas like electronic manufacturing footprint in India. It'll be strongly there in power transmission and distribution, because if the government is left with only a limited amount of money to spend, it will prioritize, and it has clearly prioritized these areas. If you look at the budget documents, while the overall capex spend might, on last year's revised estimates might grow by 10% as per FY26 budget estimate. In power T&D, in renewable power, and in semiconductor space, it's growing healthy. So that's where we positioned ourselves in the industrials, right? Can we further validate this? We can further validate this by, order book growth. So, if you look at our T&D exposure, it is through transformers and rectifiers. The order book is up 40%. Last year's sales was 1,300 crores. This year's sales is going to be 2,000 crores. Already 9 months is very strong. Next year's sales is going to be 3,600, which is evident in the order book itself. Order book execution is 15 months, and they can comfortably achieve that sales with that kind of order book. More than that, what's the pipeline of orders? It's 6x or 7x of the current order book. So there is a lot of visibility in terms of growth. The company's further strengthened its positions by backward integrating into CRGO, by being the first one with an enhanced capacity on board. So it will benefit. In terms of the other exposure in T&D, it is through the utility Adani Energy. Right. So if you look at the gross block of that company, it's around 55,000 crores. Look at the projects which it has bid for and won. The value is another 55,000 crores. These projects will get executed over the next 3 years. So you're essentially talking of doubling your revenue base in power transmission and distribution in a 3 to 4 year time frame. Add to that, they've gotten into smart metering, where there's a very large addressable market where they are amongst the lowest bidders, and they're scaling up very sharply. So clearly evident that growth can happen in these areas, simply because of the pipeline of available projects. Then if you look at the EMS space, while the stocks may have corrected simply because the valuations were where they were, all of them have grown very well. All of them have shown top line growth. Dixon is top line growth of more than 100%. Keynes this quarter was 30%, but year to date has been 40-50%. Sirma again 30-40% growth. Order books of all of these companies are growing at north of 35-40%. All of them have indicated, given the space that they are in, they can easily sustain a 40 to 45% kind of earnings growth in the next 3 years. Dixon's plans are very comprehensive. While today mobiles constitute 88% of the business, they are already approved by 4 largest vendors of laptops, to whom they'll start supplying next year. They are backward integrating into display units, display modules. So, very large headroom to grow, and especially if you're a first mover and you're going to backward integrate, your selling proposition becomes very, very strong. Today, one could argue that entry barriers in assembly are low, but if you backward integrate into, so many components, you create for yourself a very strong position. And this is, by the way, all under the new PLI, where 75% of the capital expenditure will be borne by the government. So if the project cost is for setting up a display fab, which Dixon is contemplating, is $3 billion. 2 billion, more than 2 billion is going to come from the central and the state government. And Dixon's JV partner will bear half of the balance. So very good ROC profile. If you work out the arithmetic, north of 30% ROC profile. So businesses which are going to grow very well with very reasonable capital efficiency, are where we wanted to position ourselves, and where therefore, we positioned ourselves in the industrial space. So we are not looking at, we vacated defense. We were there in defense with 2 holdings. We now have a very small position left in Mazagaon. Even that has a very strong order book and a very strong pipeline. So, in terms of fundamentals, nothing wrong there. Valuations now are more or less corrected to a point where I don't see, any further correction. So from here on, portfolio benefits with earnings growth. So, capital appreciation will move in line with the earnings growth for these companies. That's our thought on the industrials. We obviously, to balance out, our exposure, we increase our exposure to consumers through Varun Beverages. We had a position in Aditya Vision. Aditya Vision is, in retail for refrigerators, air conditioners, and basically household appliances. And their focus areas are Bihar, Jharkhand, and Eastern UP. These are states with low penetration of these goods. ACs are not optional anymore, I think. They are products which you require. These are geographical areas with much low penetration of the internet-related platform buying and selling space. So clearly, they have a good footprint there. Their growth is pretty strong. Their top line, even this year, has grown at 25%. Obviously, margins have corrected somewhat, because the kind of demand-supply situation you had last year, created favorable bargaining power, and they didn't need to discount. And therefore, margins are moderated. But it's also moderated because they are investing in adding 35-40 stores annually on a base of 160 stores. But their SSG is very strong, still at 12-13%. So same-store sales growth is strong. Capital efficiency is pretty decent at a unit economics level. So we foresee good growth for that holding. Varun, again, domestic beverages, carbonated beverages business for them can keep growing at 10-12%. The interesting bit happens in their acquisitions in Africa, where they've virtually doubled their distributor and their visi-cooler footprint in 1 year's time, and they've essentially talking of adding to their portfolio of snacks as well, and targeting a 30% CAGR over the next 3 years. So again, good growth to be had in this one. Pharmaceuticals, our exposure is largely through companies which have more of a domestic focus. And one medical devices company, Polymedicure, which has an export exposure, but a larger, virtually most of its exports is in EU. Their US business is just about starting out. So that company, again, has consistently grown at 20% plus last 5 years. Even this year, its year-to-date growth is north of 25%. More interestingly, there are 2 things. One is in India, their hospital penetration is just 30%. And wallet share-wise, in terms of products that they offer to hospitals, 20%. But they're increasingly adding to their portfolio. So if the average selling price of what they sold up to this point in time was, less than 30 rupees, which is essentially IV cannulae, they've added dialyzers, dialysis machine. Dialysis machine is 4 lakh a unit. Dialyzers are 250 rupees a unit. They're now getting into drug-eluting stents. They're getting into OT equipment. So the average selling price of what they're going to now supply in the market is going to keep on increasing. But that does not mean that their cost will also increase in line, because finally the cost is medical grade plastic, which basically means that their margins will keep on improving. So what they're essentially saying is possible is 100 basis point operating margin improvement here on the next 3-4 years, accompanied with a top line growth of 20% plus. That's again a very strong case of 25% earnings CAGR in underpenetrated markets. What has further strengthened their case is the regulatory changes. So the Indian government is now ensured that only registered entities can sell in India, and registered entities and the quality standards which are being mandated or implemented are at parity to international standards. So the fly-by-night operators, unorganized segment is going to lose market share. It's already losing market share, and that's good for them. So therefore, there are inherent fundamental strengths which we've looked at and then added it to our portfolio. One could obviously argue that valuations were at a premium. They've corrected, but now you can already see a reversal. So that's our exposure in medical consumables, healthcare. Our exposure is through Mankind and Incure. Mankind, very strong domestic franchise, right? This year, their domestic franchise growth is 9%, because of 2-3 reasons. While 9 is not bad, looked at in the context of IPM, which is Indian pharmaceutical market growth of 7%, it is somewhat lower than their trend growth of 12%. So what has happened is essentially 2 or 3 large products have come under price control. They've also over and above that, changed their discounting policy in some of their markets, and that has also led to. And in any case, acute segment of the Indian pharmaceutical market has grown barely at 4-5%, not even that. So in that context, still a reasonably creditable performance. The thesis is very simple. They're trying to, build up their basket of chronic drugs, which today is now 37% of their domestic sales and growing much faster. This comes at a 10% higher gross margin.
Fundamentals are so
Obviously,
strong.
that means that this growth is going to be margin accretive. Further, they have acquired BSV, so there will be cost synergies in BSV. And they'll obviously, cross-pollinate products. So all in all, growth-wise, I'm not concerned.
There's no concerns.
No concerns, right?
And
one could discuss at length others also, but what I'm trying to tell you is the positioning was simply to focus on growth. And from here on, now that valuations are already at parity to 5-year averages, perhaps 5% still, some room to grow still, 5% maybe. But from here on, the capital appreciation of the portfolio should fall in line with the earnings growth.
That sounds good. So, Gagan, the one last question before closing the call, as you've seen that markets has corrected very deeper. So, will you suggest to the customers who have a surplus money, is it a right time to have any top up on the portfolios for the considering on the long term point? I think there are some prices has been corrected very deeply. Like as you mentioned, some of the 30%, 40, 35% are available at a discount, right? So will you, as somebody, as a customers who are asking here is the right time to top up the money or is some more time to wait? What you suggest?
I think it's a good time to invest. Generally, the good time to invest is when you've had a steep fall. I understand that, psychologically speaking, that's a difficult thing to do, but that is the right thing to do. They may choose to invest wherever they choose to, but this is a good time to invest. Do you want to, I mean, as I've indicated, Nifty is already mean reverted. Mid and small cap indices may have 5 or 10% more room to mean revert, but that's in aggregate. We should go company by company. There are many which are already well below their fundamental valuation. So yes, it's a good time to invest. I would be happy if they choose to invest more in the portfolio. That's their discretion, but they should be investing at this point in time, wherever they choose to.
Thanks, Gagan. I think you covered about macro and about the same time in the micros of the portfolio, which means the stocks, their businesses, what their orders, everything was in detail explanation. At the same time, the last very important point is, as the markets are corrected, it's right time to enter for the long-term growth story intact. And at the same time, the portfolio earnings of the despite of the October, November, December, the broader market was not great, but this portfolio has earnings was so good. It's about 30%, 20 plus 25%. It's a very good number. So the customers, on the long term point of view, this portfolio is hold for the good. With this, we would like to conclude the quarterly update call on the ASK specified portfolio. We will be in touch with you on next quarter with the earnings and update on the portfolio. Thank you, Gagan. Closing for the call.
Thank you. Thank you for your time.